Hi, I'm Toby.
And I'm Nick.
And welcome to another pure property podcast from Track Capital, where we talk about everything property and property investment. The aim of the podcast is to give you our industry insight and knowledge in bite-sized chunks to help you invest intelligently. So we've had the latest Rightmove house price index report come through, and I think you've had a chance to sort of fully look over it, haven't you, Nick?
Yep, I've had a quick scan through, and it's very much a similar pattern to what we've seen over the past sort of month or so. Since the back end of January, the UK property market has been exceptionally busy, and this is exactly what Rightmove have reflected in what's essentially their quarterly report. So they look over, visitors to their websites, a number of listings, how quickly things are let and how quickly things are sold, and also they have a look at regional trends, etc. So if you do want to have a check, do go on Rightmove. We'll put the link in the episode comments. But effectively, what they're saying is that there's been the greatest excess of demand over supply in 10 years. It's the strongest sellers market in a decade. So effectively, people have come out and maybe been a bit more confident with regards to the lockdown restrictions easing, the vaccination rollout. There's a few more vendors or sellers which are expected to come to the market as well. Overall, it's just been exceptionally busy, high volume of transactions, and a large number of visitors to Rightmove's website as well. They were saying a daily average of 7 million visits to Rightmove in the UK, which is up 40% from the same time last year. So very much a similar pattern to the past sort of month and a half. Busy market, positive news with regards to COVID and Brexit. And hopefully that continues going forward.
Yeah, out of that report, I got a snapshot, and something that really jumped out was they've had, I think, was it in February, either the first week or something, they had 18% more inquiries from house hunters and property buyers, and the number of purchases agreed was up 7%. So yeah, really, really strong positive stuff there. So there's clearly a lot of confidence in the market, and increasing as the months go by. So it's quite interesting, especially as we had a lot of forecasters. If you think back to December, a lot of doom and gloom was saying that this year house prices were going to fall, etc., etc. I mean, again, we're only in the first quarter as it stands, but so far so good. But this week's topic is the top 10 investment jargon terms explained. Am I pronouncing that right, by the way, Nick?
Yeah.
Jargon, not jargon. Was it Anchorman? Yeah, I think it's jargon.
It's hard to know, mate.
So jargon. So yes, top 10 investment jargon terms explained. So what we're going to do is we're going to go through the top 10 that we tend to, we say when we're talking to investors, and we sometimes take for granted that not all investors will understand some of the words that we do use, just because it may not be something they've come across before. So we thought we would lay it all out in this podcast. But not only will we do the top 10, we'll also do a few more, as when we tried putting the top 10 together, we realized there was a lot more than 10, so we had to add some extras. But yeah, we will go through that later on. But Nick, why don't you kick us off with the first one?
Yep, sure. So as you mentioned, we'll go through the sort of general top 10 that we see in the property market. And then I think the second half we'll try and focus a bit more on the sort of new build and off-plan side. So all our direct investors will probably have a bit more focus on that. The first one is below market value. So this is one we commonly see touted by various brokers and agents across the country. And ultimately, as the name suggests, it's pretty much straightforward. This one is giving you, as a buyer, the opportunity to purchase a property at a lower rate than the actual open market value. So effectively, it means you're buying it at a discount. So BMV, below market value, is commonly advertised by various companies. I suppose the only word of warning we would give is to check that it actually is below market value and base that on your own market research.
Yeah, you stole the words right out of my mouth there. Always check that it is a genuine BMV, aka below market value. So next one that I will do will be capital growth or capital appreciation, as it's also known. And this is where the value of the asset or property increases over a period of time. And it's measured by calculating the difference between the price you pay or the value of the asset at the time of purchase and the current market value. So, for example, if you buy a property for £100,000 and next year it jumps up in market value to 120, you would have an increase, capital growth or capital appreciation of £20,000, which would effectively be a 20% increase in terms of capital growth or appreciation, however you describe it.
Yeah, that's pretty straightforward. That one, I think most people know to look for good capital growth and good appreciation in the specific locations that they may be searching in. Okay, cool. Moving on to the next one. One we see again touted about quite often, I suppose, as with all of these, to be honest. But ROI or ROCI, which is return on investment or return on cash invested. There's a couple of other ones out there as well, but these are probably the main ones you see. And ultimately, it's just a measure of how your property is going to perform on a financial basis. So it measures the profitability of an investment. So what that does is it enables you to directly compare to other asset classes as well, i.e., your savings account or the stock market and the shares you may hold. I don't think there's going to be much comparison to savings accounts, but yeah, it does give you a direct comparison. And then, yeah, this can be broken down by dividing your net returns, i.e., what you're actually taking home on your initial investment, and then multiplying that by 100. Would you say that's pretty straightforward, Toby?
Yeah, exactly. So the return on investment, it's your net income divided by the money you put in times 100, and that gives you your return on investment. Also, so obviously, I know you mentioned return on investment or return on cash invested. Another one I see quite often is ROCE, so return on capital employed. But yeah, exactly, pretty straightforward one again. And one that we're always using with our investors. So yes, on to the next one, off-plan property. So effectively, simple term, but actually it's not something that all investors are aware of technically and initially. This is a property that you purchase before construction has happened, or it is a property before construction has taken place. And that's what we call off-plan property. And as you'll know at Track Capital, one of our main focuses is off-plan property. So effectively, you're buying it, as the name says, off-plan. That's off-plan property.
Yeah, pretty straightforward. So basically, normally it's a case that you're just buying something during the construction process before it's reached practical completion. In some other countries, I know they refer to it as off the plan. But yeah, ultimately, off-plan property is quite well-known phrase now. Cool. Moving on to the next one: stamp duty, land tax. Most experienced investors will know what this is, but effectively, it's just a tax on the transaction when you purchase property or land in the UK, in England. Different names in Wales, etc. And it's paid on the completion of the property. So if you are buying off-plan, and that will be when you reach practical completion, or pretty much straight away if you're buying something that's ready now. So that's stamp duty, land tax, otherwise known as SDLT.
Exactly. And as I'm sure all our listeners are aware, there is a stamp duty land tax holiday at the moment, but that's a different subject altogether. But as you correctly said, it's paid on completion. Sometimes some investors may question if it's paid on exchange or completion. Again, that's relevant to off-plan property because you secure an off-plan property in exchange contracts now, but completion may be a year, 2 years away. And this has become very relevant with the stamp duty holiday because people purchasing off-plan property now, in some scenarios assumed initially that they would still be entitled to the stamp duty holiday, but again, we had to make them aware that it wasn't until completion that they pay the stamp duty land tax. So therefore, if it was completed next year or the year after, due to the holiday ending this year, they would not be entitled to the stamp duty land tax holiday. Next one up is yield. So yield comes in two forms, gross and net. And yield tells you how much of an annual return that you are likely to get on your investment. And it's calculated by taking a year's rental income, dividing that by the property cost or value, and multiplying that by 100. And then that would be gross yield. If you want net yield, then you have to deduct the costs from your income or rental income, and then obviously divide it by the property cost, that, well, the value that you paid and the amount that you paid, and then multiply by 100.
Yeah, perfect. So moving on to the next one then, service charge. So this is something we see a lot of investors potentially concerned about when they're looking at apartments, because there's a bit of a myth that there's loads of charges, etc. We don't know what they're going to be. But in most cases, you should have a service charge budget or an estimated budget provided by your broker. So you can get a good idea of what the charges are expected to be. But fundamentally, it's a charge the management company, not the individual lettings and management company, the block management company will charge investors for maintaining the communal areas of the building and making sure it's all up to scratch with insurance, lift maintenance, landscaping, rubbish collection, etc., etc. So yes, service charge is the fee paid to the management agent, the block manager, for looking after the communal areas of the building. Typically done on a price per square foot basis, can be anything from £1.80 up to over £4.25 in London, depending on the caliber of the development in terms of the on-site facility. So that's the service charge.
Yes, and also in new developments of even freehold properties now, that there tends to be a service charge because you have communal grounds. A lot of developments now have parks, sort of grassy areas and flower beds or whatever it may be. You tend to find now it's not only just leasehold, but new developments, you will have freehold properties where there will be a service charge. And that's, again, as you mentioned, to cover the cost of maintaining the communal grounds. So again, yeah, just something to bear in mind. Ground rent is the next one, goes hand in hand with service charge. So this is a payment made by a leaseholder to the freeholder. And basically, the easiest way to explain it, it's the rent on the ground that your property is on, which is owned by the freeholder, and that's what you're paying them. You can have peppercorn rent is a term used, and that's a low, pretty much virtually nothing ground rent charge in some circumstances. But yes, ground rent is an amount payable on an annual basis by the leaseholder to the freeholder.
Yep, and ideally we want to see this at about 0.1% of the property value per annum as a cost, and then hopefully in the future the government are going to minimise these fees to leaseholders as well. There has been some mention of legislation coming in, etc., to make that a bit more user friendly, so to speak. But yeah, that's one to keep an eye on. So moving on to the next one, management fee. So this is more in relation to the letting and management of the specific apartment itself, rather than the service charge, which looks after the communal areas. So you'll appoint, most likely, if you're looking for a hands-off, fully managed structure, a local managing agent who's familiar with the development and the area, and they'll take care of finding the tenants, doing reference checks, taking deposits, and ensuring that the tenancy runs smoothly, ultimately minimizing voids and maximizing your return on investment. So yeah, we always recommend finding a good managing agent. We can help with that on our developments, and that will be a cost that you have to think about. So that's the management fee.
Yep, spot on there. Conveyancing process is the next one. So conveyancing process, or the legal process, this is the process that takes place when undertaking the legal transfer of home ownership or property ownership from the seller to the buyer. So this is where essentially the solicitors do the legal paperwork and process on the buyer's behalf and the seller's behalf for the transaction to go through and get to exchange and completion.
Excellent. So moving on to the next set of keywords that we're going to focus on. So as I touched on at the beginning, this is more related to the new build and the off-plan investment market. So these are some phrases that we really do use often, and hopefully it will be useful to our listeners to sort of unpack these a bit. So the first one is the reservation fee. So this is a deposit that's paid immediately to secure a property and take it off the market. So it can range from anything from 500 up to £5,000. That will go over to normally the agent, who will then in turn send it to the developer. But basically, that shows your financial commitment to the property and then gets the ball rolling in terms of the legal purchase process.
Next one, interest on deposit. So this will be paid by developers on off-plan projects. This is there to incentivize buyers to purchase early and then still enable them to beat the banks or have their money working hard for them, because in some circumstances an investor, they're investing for the reason that they want their money to earn them more money and work hard for them. So sometimes when a development is off plan, a developer will then incentivize them by giving them interest on their deposit during the construction phase, and it tends to then come off the purchase price in most circumstances. So yeah, that one is interest on deposit.
Yep, and then we want to just quickly on that point. We want to make sure that we're not just paying an inflated price at the start, because that's something we have seen in the past by one or two dodgy developers. Not so prevalent these days, but yeah, just got to make sure we're paying a fair price to the start with in the first place. Cool. So moving on to the next one, flipping. Or a flip, that is a phrase which probably most people have heard. It's just ultimately where you're purchasing a property with the intention of selling it in a short time frame, usually for a rapid profit. So it might be the case that you've bought a distressed property, or you've bought off someone who's looking for a quick sale. You've bought at a discounted rate just because it's below market value for whatever reason, and there might be a good opportunity to sell it in 3-6 months or even less, for a quick profit and make 10-20 grand or whatever it may be. But yeah, that's the process of flipping.
And flipping is also used in off-plan investing, where some purchasers, they may buy 2 years in advance, for example. Over that 2 years, if they've obviously got a discount or a good price because they're buying off-plan, they then have capital growth over that period as well. Come towards the completion date, they may decide, well, actually, I'm going to sell this on for a profit. Now, prices have gone up. I got a discount, and I can see similar properties are going for higher prices, and they can actually sell it before completion. Just note that you will have to be allowed to do that within your contract or your sale agreement with the developer, and usually that is the case, but always do check that. But that is a strategy some people do have, not one that we recommend as it comes with its risks, but yeah, can also be very profitable, because if you flip before completion, you don't actually pay stamp duty either, because as we mentioned previously, you pay that on completion. So that obviously helps with your profit margins quite well. The next one is serviced accommodation, also known or seen as SA. And this is a letting model where the managing agents or the owner of the property focuses on short lets and renting the property out for a short period of time. This could be a day, a week, a month, depending. And it's you have examples such as Airbnb that operate in this manner, or spare room, or wherever it may be, and they charge a premium for that because it's a short let, similar to that of hotels, for example. You tend to find the cost can be quite similar, sometimes higher because you're getting a whole apartment in some instances, and that will massively improve your yields.
Yeah, so I think at some stage it's probably worth doing a podcast on this subject alone. But yeah, just a point that I would pick up on is that when a company might be advertising a development or an apartment building with short-term let approval or a serviced accommodation approval, it means that, as the name suggests, you are legally allowed to do that. It's written in the lease that you have approval as an owner to let it on a short-term let basis, which most developments you see out there, most new builds, you actually don't have that approval. So when you are reviewing options, it's really handy to have one that is short let approved, because you have the chance to potentially give it over to a management company. No more extra work involved on your side, but it means you can really drive up that rental yield. And then when you come to exit, it means that the future buyer, who's more than likely going to be an investor, will also be attracted because you'll have that short-term let approval and that ability to earn a higher return. So yeah, serviced accommodation and short-term let approval is something we're seeing more and more of, and something we are quite focused on internally. So yeah, good stuff. Cool. So moving on to the next one, equity. So this is typically referred to as the profit that's built up from owning a property over the time. So similar to capital growth or appreciation, whereas equity would be that specific value that is built. For example, if you purchase a property for 200,000, then further down the line it's worth 220,000. It means you've built up potentially £20,000 equity in the property. I'd say that's probably the most common context in which it's used. And yes, that's equity.
Brilliant. Next one, diversification. This is something we talk about with a lot of our investors, and this is effectively not putting all your eggs in one basket, as to say. So this is where you spread the risk. So this may be a case of buying different properties. So you might buy some one beds, some two beds, some three beds, some apartments, some houses, spread the type of property that you're buying. You may spread the locations. So you may do a few different cities, different sizes, different investment classes. Basically, what you're doing when you diversify your portfolio, effectively spreading the risk, because with different investment types, obviously they are usually affected in different ways depending on different market conditions. So by having lots of different ones, you help spread the risk, because realistically they're not all going to be affected at the same time. So diversification, not putting all your eggs in one basket.
Yeah, makes sense. Makes sense. Cool. So moving on to number 7 now of 10, assured return. So this is what you sometimes see advertised as contractually guaranteed income, assured return. So it's effectively an agreement that off-plan purchasers have with a developer. It's a legally binding contract that's verified by solicitors during the purchase process, and ultimately it's the process of the developer slash management company paying you a fixed return and contractually guaranteeing your income, irrespective of things like void periods or late rental payments, etc., directly from the tenant. So, yeah, you'll commonly see on residential properties rates from 6 to 7% net, sometimes a touch higher, and that can be fixed for a year or two. I think the longest one we have on the residential side is 8% net for 3 years. So yeah, it just gives buyers a bit of confidence knowing that if they've got a big unit that's due to complete, sorry, a big apartment building that's due to complete soon, and you haven't got hundreds of units coming to market. So it just makes it a bit more secure for buyers. But again, it's the same concept as interest on deposit. You've got to be careful you're just not paying for it up front. You're not paying an inflated price in the first place. So it can be a good point to focus on and a good feature of an investment if it's the right type of insured return or right in type. So it could be a good one to focus on when you are reviewing your different investments and opportunities, but you just got to make sure it's structured correctly.
Exactly. And it's a great incentive to have. But as you touched on, it is a contractual agreement. So, yes, it is legally binding. It is a contractual agreement. However, there are still risks involved. If that company goes bust after completion and you've got the property, they may not be able to pay the fixed amount. The worst case scenario is then you go to just your standard market rent. But yeah, just something to bear in mind. We say assured rent, and we always give the caveat of contractual agreement, because in all investment scenarios, it's not 100% guaranteed. So just always bear that in mind as well, because sometimes investors have the perception that it's 100% secure and absolutely fine, and there will be no downside to taking on a property with assured returns. Next one is SPV. So that's the abbreviation for Special Purpose Vehicle. So this is a limited company formed for the specific purpose of purchasing a property, and it can be both individual investors and also developers themselves.
Absolutely. So yeah, SPVs, limited companies. So as you touched on, this is something we're seeing a bit more commonly from direct investors that will set up a company to buy a property for the tax benefits. That's an SPV. Or if you've got a developer building 500 units and they're structuring the build into a company name, that's an SPV as well. So yeah, just a limited company, but that's becoming more, well, it's virtually an industry standard now for development. Cool. So moving on to number 9 then. So leveraging. It's kind of a two-parter, this one. So leveraging just means using finance effectively. In most cases in property, it's using a straightforward buy-to-let mortgage. So that's obviously not having putting down a deposit, typically in the region of 25 to 30%, and then securing a loan on the remaining balance to purchase the property. But yeah, leveraging just means using sort of some form of finance. In terms of the second part, so we've got agreement in principle. And this is quite common for us because we're doing a lot of off-plan stuff. When you purchase an off-plan property, the most you're going to get from a lender at that stage is an agreement in principle, obviously because they don't have the facility to value the property at that time. Mortgages will be formalised normally about 3 months prior to practical completion. However, if you wanted to, get an indication of what you could potentially borrow at what rate over what time frame, you can get an agreement in principle, which will give you a really, really good idea of what you can expect on the mortgage side of things.
Yeah, sum that up perfectly there, Nick. Next one, and last but not least, at number 10, we have exchange of contracts. So this is when funds are paid and contracts are exchanged, and then the sale and purchase becomes legally binding between the buyer and the seller. So this is exchange of contracts. So the buyer is legally obliged to purchase the property at the price agreed, and the seller is legally obliged to sell the property at the price agreed.
Okay, good stuff. So yeah, that's pretty much wrapped up our, so I think it was a total of 20 terms covering the general property market, and then a bit more of a focus on the new build and off-plan stuff. So yeah, the only thing we'd add to that is if there's anything that you want to go over personally, if you're reviewing sort of emails and offers from other sort of companies, etc., and you want a second opinion or not too sure on anything, even if it's from one of our internal team, we'd always advise you to make sure you seek clarification and understand all the jargon, especially probably more relevant is on the actual legal purchasing side when you're dealing with the contracts and the solicitors directly, as well as making use of your broker. Always make use of your solicitor. Don't be afraid to take a few days longer to read over and make sure you understand everything in great detail. I'm sure most people would, but yeah, sometimes you can get a bit of a pressure to get the transaction done quickly, especially at the moment if we're trying to meet stamp duty deadlines, etc. So yeah, always double check the meaning of all the words and phrases.
Perfect, Nick. Perfect. So, next week's episode, the subject will be freehold or leasehold. Which is best? The age old question, the debate that we have on a number of occasions with investors. So, that's what we're going to go over next week. Tune in to find out what we think.
Yeah, so we've got a few exciting ones coming up. So yeah, the freehold versus leasehold debate, as you said, it's almost a daily basis that people were weighing up the pros and cons of each. So it'd be good to explore that a bit further, and hopefully further down the line we can focus on some of these terms that we've discussed today, such as your finances, so your calculations and your formulas you need to know. A bit more on the location side of thing. Hopefully, we'll do a deep dive into the Liverpool market soon, and yeah, eventually get some video content as well. But yeah, plenty in the pipeline.
Sounds good. Well, thank you for tuning in again this week, and we look forward to seeing you next time. Bye bye.
Thanks, everyone. Bye bye.